Yield is a fundamental concept in finance. It is the dividend payout you get from a stock relative to the price of the stock. If you are an investor or a lender or debtor for that matter, you must understand yield. In this video, I'm going to explain to you what you need to know. I'm Dave Van Knapp with the Dividends and Income channel. Before I get going, please help us out by clicking the thumb up, subscribe to the channel, and ring the bell so that you get notifications when we put up a new video. Thank you. Let's start with a standard definition of yield. Yield equals 12 months of dividends divided by the stock's price. This is pretty simple, right? You can think of yield as being like a bank stating the interest rate that you're going to get on savings that you keep in the bank. Assuming that a company's dividend is neither cut nor raised over the next 12 months, current yield tells you what your rate of dividend return will be on that stock over the next 12 months. For example, if a stock pays $1 in dividends in a year and its shares cost $10 each, it's yielding $1 divided by $10 or 10%. That will be your dividend return on that stock, on a share of that stock, expressed as a percentage. However, sometimes complications enter into yield calculations. For example, which 12 months are you using? You could use the last 12 months or a projection of the next 12 months. They lead to different answers. For a second example, what price are you using? Today's price? The price at the beginning of the prior 12 months? Again, they lead to different answers. And for a third example, are you including price gains as well as dividends or distributions in your 12 months of dividends? Again, obviously, that would change the answer. These different answers lead to what I call different flavors of yield. Each flavor has its own meaning and usefulness. And to be honest, not all of the sources that you look at will clearly label what yield they are showing you, meaning that you can fall into traps and misunderstandings if you don't know how the yield being displayed was computed. What I'm going to do is walk you through the different flavors of yield, the most common ones, and tell you how they're computed and how to use them. And I want to address that third variation that I already mentioned. Don't ever include price returns when you are using the word yield. The best way to understand yield is to confine it to money that the company or the stock sends to you and leave out the additional returns or losses that you might experience from changing market prices. Price gains or losses are not part of yield as far as I am concerned. They are better considered to be part of total return. So keep yield confined to the distributions that you receive. Leave out market price changes. Current yield is, in my opinion, the most common flavor of yield and the one that you will find the most useful. Usually, if you just see the word yield on a website and it's not labeled otherwise, they are referring to current yield. What current yield means is the yield you are making right now on the dividend-paying investment. Okay, now we're going to start to deal with our basic definition of yield. And as I go through the different flavors of yield, I'll show what I use in the two places that we talked about. What are you using for 12 months of dividends, and what are you using for the stock's price? In the case of current yield, for the 12 months of dividends, you use the projected dividends to come in over the next 12 months. And for the stock's price, you use the stock's current price, the price right now. Here's a generic example of what I just said. Current yield is 12 months dividends divided by stock price. Say that a stock is projected to pay $1 in the next year in dividends per share. And for item number 2, the stock's current price is $50 per share. That would mean that stock's current yield would be $1 divided by $50, which is 0.02, which converts to 2%. You can always convert a fraction to a percent by multiplying it by 100. Now, how does anyone know what the next 12 months of dividend payments are going to be? After all, they haven't been paid yet. Here's how it's done. It is standard practice in the investing industry that when a stock follows a regular pattern of dividends, it is assumed that over the next 12 months, unless the company has announced a change, that they will pay the same amount in dollars and cents as the most recent dividend that they did pay. Now let's look at a real stock. This shows the company Cisco as portrayed on E-Trade, where I keep two of my own portfolios. This is the snapshot that shows up first to give an overview of the company when you first click on it on E-Trade. I've highlighted two things on this slide. Number one, the price at the moment that I took this screenshot, which was $55.865 per share for 1 share of Cisco. And over on the right, the quarterly dividend / yield, which was $0.38, which is to say 38 cents per share, and then the slash mark, and then the conversion of that figure to what they call simply yield, 2.70%. The 0.38 or the 38 cents per share is Cisco's actual last declared dividend. And E-Trade has labeled it as quarterly, so we get the obvious conclusion that Cisco pays its dividend 4 times a year. Let's figure out on our own Cisco's current yield from the numbers that E-Trade has given us. The projected dividend is 38 cents a share. It's a quarterly dividend, so to project it out to annual, we multiply by 4, which equals $1.52 a share in a year. And the current price, as we saw, was $55.865. So the current yield is $1.52 divided by that price, which equals 0.0272 multiplied by 100. That equals 2.72%. Note the slight difference in my result from what it said on E-Trade. I did the math and I know that the answer is 2.72%, but E-Trade displayed 2.70%. That's insignificant in this example, but I just want to expose you to the fact that in investing, when you're getting numbers off the internet, you will run into answers that are sometimes slightly off. All I can say is get used to it because it happens all the time and we all have to deal with that. Before we leave the subject of current yield, I want to show you why it is valid to project unknown future dividends by multiplying the most recent dividend by 4. Here is Cisco's dividend for the past 5 years. Cisco shows the consistent pattern that we see with so many dividend growth stocks. They raise their dividend once a year, then pay the same amount each quarter for a year. That appears as the flat part of each stair step on this display. The last amount that you can see off to the far right is the 38 cents that we have been seeing already as Cisco's quarterly, not their annual, their quarterly dividend. Going by what we called industry practice before, a source like your brokerage or Yahoo will not presume that the company will make a raise, even if the company has been raising its dividend for 50 or 60 years in an unbroken pattern. That's prudent. No one can ever presume a dividend increase, even though we all expect that Cisco will in fact raise its dividend at some point during the next 12 months. So, that knowledge aside, multiplying the last quarterly dividend by 4 is a perfectly reasonable way to project Cisco's next 12 months worth of dividends. I want to leave with 2 more final thoughts on current yield. First, the reason it's called current yield is that it is the yield that you are earning right now per year on your money. It's kind of the equivalent of an interest rate on a savings account. It shows how much you're earning for having your money invested in the savings account. Second, because current yield is based on 12-month projections out from the current time, it is sometimes called projected yield, forward yield, or indicated yield. They all mean the same thing. Here's a display about Cisco from Yahoo that I grabbed about 5 minutes after the earlier example that I got from E-Trade. So a couple of numbers have changed slightly. I'm just showing this to you to show you that Yahoo uses the term forward yield for its current yield display. Note also that they did the multiplication force. They multiplied that 38 cents by 4 and got the $1.52 that I did when I did my calculation of Cisco's yield. That way, Yahoo shows Cisco's annual dividend, not its quarterly dividend. And finally, just for completeness on the subject of current yield, let's change the heading on this display, which you've seen before, to get all the common terms for current yield in the same place and defined correctly. So the heading on this slide now says somewhat redundantly, yield, current yield, projected yield, forward yield, and indicated yield. As I said before, they all mean the same thing. And that brings us to the end of the discussion on current yield. Let's move on to a different flavor of yield. Now I want to tell you about the ramifications of owning an ETF instead of a stock. We saw that with Cisco, their dividend is flat between increases. They pay 4 dividends at one amount raise it once a year, pay 4 dividends at that amount, raise it once a year, and so on. And they do that at about the same time every year, the raises. Most stocks are like that. Here's a 5-year chart of the dividends of 4 popular dividend growth companies. Cisco's on here. It is in orange. This chart also has Johnson & Johnson in purple, Microsoft in blue, and Apple in green. And you can see that they all have that same stair-step pattern. 4 dividends at one amount, an increase to a new amount, then 4 dividends at that amount, and so on. Nice and smooth and steady and predictable. I could have put 100 dividend growth companies on this chart, and they would all look like those 4. The only differences are what time of year they deliver their increases and how big the increases are. So, once again, it's easy to see why it's logical and prudent to project their most recent dividend 12 months forward to get the full 12 months worth of dividends that we need in the yield calculation. Usually the only thing that throws that calculation off is that the company does raise its dividend during the next 12 months. And your forward estimate, therefore, turns out to be a little smaller than how much is actually paid. That's fine. Your actual income ends up being a little bit more than you had projected. But what if you have a security whose dividend record looks like this? This is a 5-year chart of an ETF, QYLD, that is popular with dividend investors. I own some shares of QYLD myself. It pays monthly, so there are more data points. But even more important, its dividend is different every month. And this is true with all ETFs that I've looked at. Their payments are variable. They're not flat like stocks, 4 in a row, or in the case of a monthly pair, 12 in a row, then 1 bump for a year, and then a flat, identical amount for every payment in that year. ETFs are different. Their dividends go up and go down. There may be a trend line that can be detected through all that noise, but the bottom line is you can't really project an annual amount of dividends by simply taking the last dividend they paid and multiplying it by 4, or in the case of this ETF by 12 because it pays monthly, because your yield calculation will jump up and down just as the amounts of the dividends jump up and down. Those jumps in the yield calculation really wouldn't have any significant meaning. They would just reflect the jagged nature of the dividends themselves. Given a situation like this, what's the smartest thing to do? I think that the soundest way to project variable dividends forward is to total up the last 12 months of actual dividends and use that as the 12-month amount that's needed in the yield calculation. Obviously, this is a different approach from the convention for stocks, but at least it's real. Those dividends were actually paid. It's prudent. And most important, the yield calculation won't hop around very much from payment to payment because the grouping of a year's worth of those variable dividends together tends to have a smoothing effect on the yield calculation. It doesn't hop as much with each change in dividend as that single change would cause mathematically. Here are QYLD's last 12 monthly dividends. This display is from Yahoo, and because it has 12 monthly dividends, obviously it covers 1 year, but here now we're looking backwards. These dividends were actually paid. And at the bottom, I added them up, and the total dividends for 1 share of QYLD for a year totaled $2.794. In this display now, we make an example out of what we've just seen with QYLD. Again, we're going to use the base formula, which is 12-month dividends divided by price. For the 12 months dividends, we're going to use the last 12 months actual dividends, which we just saw totaled $2.794 per share in a year. And for the price, we're going to still use the current price, which is $19.92. That means the QYLD's current yield, as I would calculate it, comes out to 2.794 divided by 19.92, or 14.0%. At this point, I've got to show you this for 2 reasons. Number 1, I think you'll be amazed. And number 2, it's really a good learning opportunity about getting figures from the internet. What the slide shows is 6 displays of yield of QYLD that I got from the web, plus my own calculation at the bottom. They're all different. The yields displayed range from 10.9% to 14.6%. That's a 34% different from the lowest yield displayed from one source to the highest yield displayed from another source. If you're making investment decisions, that is a mammoth difference. And once again, it just shows that when you're using the internet, as we all do, to get numbers, you've got to use some care, maybe look at multiple sources, or maybe do your own calculation as I did. Notice at the bottom of this slide that Simply Safe Dividends at 13.9% comes the closest to my own calculation of 14%. And I've talked to Brian Bollinger at Simply Safe Dividends, and I know that he uses the same approach that I do, which is to take the last 12 real dividends, the ones that have been paid, and use that in the calculation. The slight difference between our answers came from rounding. The display I showed you from Yahoo of QYLD's dividends just a few moments ago rounds those to 3 decimal places, and I looked on Global X's website. Global X is the company that offers QYLD, and those dividends are actually calculated out to 4 decimal places. So in my calculation, where I added up the 12 dividends, I was using dividends that were accurate just out to 3 decimal places rather than 4. I'm sure Brian's correct that the actual yield calculated in that way is 13.9% compared to the 14% that I got. One other thing I want you to notice on the chart is the third entry from Schwab. The yield displayed is 10.9%. That was the low among all of these. They called it distribution yield TTM, which stands for trailing 12 months, but I put in red a comment. They included capital gains and losses in their calculation according to the explanation they make about their calculation that you can access with a jumping off point right at the calculation in their display. And remember earlier in the video, I said don't mix in price gains and losses when you're calculating yield. It's just not a good practice in my opinion, even though it is a somewhat common practice. They're the only purveyor of information among the 6 that I used here that I could tell for sure was doing that because they stated it. So the bottom line for me on this kind of thing and the lesson to be learned here again is be careful with numbers you get off the internet. At a minimum, if you're comparing yields among ETFs, get them all from the same source. At least that way you can be pretty sure that they were all calculated the same, so they'll be correct relative to each other. And of course, you can always calculate the yield yourself by adding up the last 12 months of dividends and using that as a 12-month number in the calculation, the way I did. There's one last thing to mention about the yields from ETFs. All funds are required to calculate something called the SEC yield by the Securities and Exchange Commission. I'm not going to try to explain all the details SEC yield. It's actually a complex formula that uses information from the past month and then it's annualized. I personally don't find SEC yield to be very useful. It was originally developed for bond funds where I guess it has more use. You will see SEC yield stated for most ETFs when you look them up. Since it comes from the fund itself, you would think that every source shows the same number for SEC yield. But following the pattern that we've seen about numbers on the internet, you would be wrong in thinking that. I looked up a few sources for QYLD and I saw numbers for SEC yield that ranged from 0.12% to 3.04%. They're way off from each other and they're way off from what we know the current yield is of QYLD, no matter how you calculate it, based on its actual dividend payouts. So for me, in my own investing, I don't pay any attention to the SEC yield for stocks. The last flavor of yield that I want to tell you about is called yield on cost. Yield on cost is not something you look up because it's personal to you. It's the yield you are getting now based on what you paid for the stock when you bought it, whenever that was, 1 week ago, 10 years ago. Yield on cost starts with our standard formula, which is 12 months of dividends divided by the stock's price. For yield on cost, for the 12 months dividends, we use the projected next 12 months dividends as we did with stocks. But for the stock's price, we now use the price that you paid when you bought the stock. Now here's a generic example of what I'm talking about. Let's say we have a stock that is projected to pay $1 in the next year in dividends per share. And when you bought it, the stock's price was $10 per share. That means that the stock's yield on cost to you is $1 divided by $10 equals 10%. Now, I want to show you how this works in real life. Again, I'm going to use Cisco as an example. I own Cisco in my dividend growth portfolio, and this is a screen grab of the line item in my portfolio that shows my ownership of it. I own 118 shares of Cisco. My total cost for all those shares is already added up because I'm looking at it in my portfolio. It's $3,478, and its estimated annual income, which E-Trade projects for me, is $179 plus change per year. On this slide, now we use that example in the format that I've been using throughout this video to show the similarity in yield no matter what flavor you're using. In this case, for my ownership of Cisco, my projected dividend is $179 for the coming year. So I got the 12-month dividend part, and the price I paid was $3,479 for the shares that I own. So I have the stock price part. So Cisco's yield on cost to me is $179 over $34.79, which is 5.1%. Cisco's current yield is 2.72%. Remember that yield on cost is personal to you because it pertains to the price you paid, not anybody else. So obviously, yield on cost is dependent on when you bought the stock, which could be a long time ago. Now, here is something cool about yield on cost. If you start a portfolio with a lump sum of money, say you get an inheritance or a payout from a 401k, you're rolling a 401k over into an IRA. And if you never add new money to it, it's easy to calculate the yield on cost of your whole portfolio. I do just that with my public dividend growth portfolio every month. Here is the display of the kind of top line statistics from that portfolio at the beginning of this month. I've highlighted two things. The yellow highlight is the annual dividend run rate for the whole portfolio. It's $5,509 per year projected out right now. And the yield on cost that portfolio has achieved, which is 11.8%. Here's the yield on cost calculation for my portfolio. Again, we've got the projected 12 months dividend, $5,509. The price I paid for that portfolio when I started it in 2008, and I've never added a dime of outside money to it, was $46,783. So at the bottom, its yield on cost to me right now as we speak is 11.8%. What does that mean? It means that my portfolio is now returning to me in cash every year an amount equal to 11.8% of the money that I spent originally to set the portfolio up in 2008. That's what the $5,509 a year is. It is 11.8% of the money I spent to establish the portfolio almost 14 years ago. That percentage, by the way, keeps setting new record highs because the income in my portfolio keeps going up. As companies raise their dividends and I invest the dividends, which creates a compounding effect that I've talked about in other videos. I like to keep track of that number because rising annual dividend income is the core goal of this portfolio. By the way, on this slide, the blue line across, which I drew in at 10%, that was my original goal when I started the portfolio. I wanted to reach 10% yield on cost because I just thought that was an amazing concept at the time I started, that I could set up a portfolio in 2008 and at some point in the future, it would be sending me 10% of that original amount back every year. As you can see here, I surpassed that sometime during 2020. And now, as of the end of 2021, we're up over 11%. And as I record this video, as I just told you, it's at around 11.8%. I need to tell you that there is some controversy about yield on cost because some investors think that it's a useless metric. I don't think that. Yield on cost demonstrates that I am receiving a higher dividend return based on the price I actually paid, then the current yield would indicate. The current yield on that portfolio is 3.2%. Some people criticize yield on cost as just a backwards-looking, feel-good number. They say that it shows only what has already happened and plays no role in current or future decisions about what to do going forward. Here's what I say. It is true that yield on cost is like looking up at a scoreboard and seeing what's happened. In fact, I call yield on cost a scoreboard metric in that it shows what has already been accomplished, and it really doesn't come into play in making current investment decisions. However, I don't find yield on cost to be useless. Here's what I use it for. Two things. Inspiration and a check on how I'm doing. When I began the Dividend Growth Portfolio in 2008, I set its mission to generate a growing dividend stream over time. That can be measured, as we've seen, either in dollars. My portfolio is now yielding $5,509 per year. That's its run rate of dollars. Or it can be measured by its yield on cost, which is simply a conversion of that number to a percent. I found it inspiring and still do to think that 13 years after I started it, the portfolio could be returning to me in cash nearly 12% of its original value per year. Knowing that record of success also provides an inspiring foundation for me to keep doing what I'm doing, to stick with a plan. That brings us to the key takeaways from this video. Here's what I want you to learn or remember from the video. Key takeaway number 1, yield. The word yield means 12 months of dividends divided by the stock's price. Takeaway number 2, yield is an annualized figure. Number 3, yield tells you the dividend return that you can expect from a stock over the next 12 months, expressed as a percentage, not as a number of dollars. Number 4, it's a better practice, in my opinion, not to mix price returns with dividends when you're talking about yield. Confine the word yield to the money that the stock sends to you. Leave price changes out of it. Number 5, the most common flavor of yield is current yield, a projection of the next 12 months' dividends divided by today's price. That, by the way, can be called just plain yield, forward yield, or indicated yield. They all mean the same thing. Takeaway number 6. Yields on ETFs are a little harder because ETFs pay variable dividends. That makes it difficult to project 12 months worth of dividends into the future. I think that the best practice is to use the trailing 12 months actual dividends rather than project the last dividend forward when you're calculating the yield on an ETF. And finally, takeaway number 7, another flavor of yield is yield on cost. That means the yield based on the price you paid rather than the current price of the stock. And as we saw in the video, you can figure yield on cost for a single stock or a whole portfolio. It is fun and inspiring to watch yield on cost rise as your companies raise their dividends and you reinvest them. And that brings us to the end of this video. Thank you for sticking through this if you're still with me. Remember the takeaways, review them. That should trigger what you learned in the video. And I will see you next time. Bye, everybody.